Ladies and gentlemen, good day and welcome to Modi Naturals Limited Q2 and H1 FY'25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference call is being recorded. I now hand the conference over to Joint MD, Mr. Akshay Modi from Modi Naturals Limited. Thank you, and over to you, sir.
Thanks. Good afternoon, ladies and gentlemen. Thank you for joining us for the Modi Naturals Q2 and H1 FY'25 earnings conference call. I trust you have had an opportunity to review our financial results and investor presentation, both available on the company's website and stock exchanges. SGA, our investor relations advisor, is joining me on this call. Given that this is our first earnings call and for the benefit of the participants at large, I will give an overview of the company, followed by financial performance for the quarter and half year ended September 24. At Modi Naturals, our journey began in 1974 under the visionary leadership of the D.D. Modi. From modest beginnings, we have grown into a household name and a trusted provider of healthy, high-quality edible oils and innovative FMCG products. With the vision centered on producing premium edible oil and food products, we have maintained an unwavering commitment to quality and innovation. In 1985, we expanded our operations by establishing a new solvent extraction plant in Pilibhit, Uttar Pradesh, as part of a greenfield expansion. This facility has evolved into a fully integrated oil extraction, refining, and packaging plant. Our primary objective was to supply top-quality edible oils to Indian households, which at the time had limited options for quality, purity, and health benefits. In the early years, our primary focus was on rice bran oil and a high-quality byproduct, de-oiled rice bran, which is an animal feed ingredient. Through rigorous quality control and a commitment to traditional values, we quickly earned the trust of our customers. As demand grew, so did our product portfolio, expanded to include a variety of oils such as olive oil, multi-source edible oil, and canola oil, each known for its nutritional benefits. We invested in advanced extraction and refining technology to ensure that every drop of oil met stringent quality standards, providing an added layer of health benefits that consumers could rely on. At Modi Naturals, we have three divisions: the bulk oil division, branded consumer division, and the ethanol division. Let me begin with the bulk division. Our bulk division is vital to our overall strategy, focusing on the procurement, processing, and distribution of various edible oils in a dynamic market. This segment allows us to capitalize on price fluctuations and shifts in consumer demand, optimizing our inventory and maximizing profitability. By leveraging our extensive network of suppliers and customers, we navigate the complexities of the oil trading landscape effectively, along with backward integration. However, the last few quarters have been particularly challenging for our bulk division, which, despite having a manufacturing back-end, has a trading element. It faced significant obstacles due to government-imposed price restrictions on edible oils, leading to considerable inventory losses. Market volatility and shifting demand further exacerbated these challenges, impacting our trading margins and operational efficiency. Fortunately, we are beginning to see signs of recovery, prices have stabilized, and we believe the worst is behind us. Favorable rainfall across the country and the arrival of fresh crops are creating a more conducive environment for trading. As supply chains normalize and demand picks up, we expect to see positive momentum in our bulk trading segment moving forward. Coming to our consumer branded division. A major milestone in our journey was the introduction of Olive, a brand of high-quality, heart-healthy cooking oils in 2012. Our flagship brand, Olive, and particularly Olive Active, quickly became a popular choice for health-conscious consumers in India, combining olive oil's benefits with everyday cooking oil's versatility. By focusing on scientifically backed products that address health concerns like cholesterol, cardiovascular health, and overall a fitness lifestyle, we successfully reached a rapidly growing market of health-conscious individuals seeking more from their everyday ingredients. Olive oils became synonymous with quality, lifestyle, and wellness, and the brand continued to innovate by introducing more varieties to cater to diverse cooking needs. We are currently the only major player in India producing multi-source edible oil with olive oil, and we are the country's third largest super premium edible oil brand. Our journey was not without its challenges. As the company grew, we faced intense competition from both domestic and international players. The edible oils market is highly competitive, with numerous established brands and the constant pressure of fluctuating raw material prices. However, we approach these challenges with resilience and strategic foresight by implementing cost-effective manufacturing practices without compromising quality and building strong relationships with suppliers. We were able to maintain stable prices. Furthermore, we adopted a multi-pronged approach, expanding our distribution network, strengthening our R&D efforts, and implementing modern marketing strategies by partnering with retailers and distributors across the country. We achieved nationwide reach, making our products accessible to both urban and semi-urban consumers. Our strong logistics network became a competitive advantage, allowing us to maintain a robust presence throughout India, as well as some neighboring countries. We strategically selected our market presence. In our consumer business, we do not focus on commodity-based edible oils such as soybean, mustard, and sunflower oil. Instead, we cater to the premium multi-soils oil segment, which includes blends like rice bran plus olive oil and rice bran plus sunflower oil. We market these products under brands Olive Active, Olive Gold, and Olive Smart. Additionally, we have extended our offerings into the super premium edible oil category, which includes olive oil and canola oil. These products are marketed under the brands Olive Kitchen, Olivana Wellness, and Miller Canola Oil. Additionally, we reinforced our commitment to quality and transparency by investing in R&D facilities and enhancing our product packaging to clearly communicate health benefits. This dedication to innovation and consumer focus paid off as more people recognized and trusted Modi Naturals as a provider of healthier, high-quality oils. While we had already established a name in edible oils, our ambition did not stop there. Recognizing opportunities in the FMCG sector, we strategically diversified our product line to cater to a broad range of consumer needs. This expansion enabled us to enter new product categories, including premium oils and other food items, thereby creating a strong, diversified brand presence. Recently, we also ventured into the ready-to-cook snack category, introducing products that align with our philosophy of health, convenience, and taste. We have developed strong brand identification to better align our products with consumer expectations. For example, the Olive brand is associated with health and wellness, which is why we extended it under a sub-brand Olive Kitchen, with which we guarantee healthier for you food products with significant innovation and product differentiation, ensuring our consumers receive high quality with great taste and nutrition. This range includes items like Olive Kitchen pasta and peanut butter and Super Soup, India's first ready-to-cook soup with pre- and probiotics. Additionally, we elevate the snacking experience. We introduce Pipo, our popcorn brand, which comes in flavors such as cheese burst, peri-peri, tomato salsa, and tandoori. Our roasted peanuts also offer both international and local flavors, including smokehouse barbecue, Himalayan rock salted, etc. To enhance the beverage experience, we launched Jinx, a line of powdered, ready-to-mix drinks available in various flavors enriched with vitamin C. Our products cater to a generation seeking quality, taste, and nutrition in quick-to-make food options. The decision to expand into FMCG was driven by our desire to provide consumers with choices that are not only healthy, but also flavorful and convenient, aligning with modern lifestyles. Additionally, we will leverage the ecosystem that supports our oil business, including quick commerce and e-commerce platforms, a robust network of distributors, direct access to retail stores, modern outlets, and CSD army canteens. This approach will allow us to efficiently distribute our products while ensuring they are readily available to consumers in various shopping environments. By utilizing these established channels, we aim to enhance visibility and accessibility, ultimately driving sales and strengthening our market presence. This integrated strategy maximizes our reach and fosters greater customer engagement and satisfaction. This will reduce our effort to a large extent. Introducing these new products is a testament to our adaptability and vision. By closely monitoring consumer trends, we swiftly identify and address market gaps. We have been in the branded consumer business since FY’25, and from day one, we have approached our decisions with extreme caution and careful analysis. Our business has been profitable from the very beginning, which underscores our commitment to sound strategies and prudent management. We will continue to uphold this philosophy as we move forward, ensuring sustainable growth and long-term success in a competitive market. Let me now move on to our new segment, the ethanol division. We strategically entered the ethanol division, a move that promises both economic growth and a positive environmental impact. Let me explain the reasoning behind this expansion. India is aggressively pursuing energy self-reliance with an ambitious goal to achieve a 20% ethanol blend in petrol by 2025. This shift toward ethanol, a biofuel derived from biomass resources, holds great potential for reducing fossil fuel dependency, enhancing energy security, curbing environmental pollution, and increasing farmer and rural income. The government's strong push for ethanol in production via the EBP program presents a valuable opportunity for companies like ours to diversify into a sector with rapidly growing demand. We have a rich legacy in processing agri-products. With decades of expertise in oil extraction and refining and the safe handling of resources, we have developed the necessary infrastructure and technical know-how to transition seamlessly into ethanol production. Our agri-processing sector experience equips us with the critical skills required for efficient processing and product quality management, two key aspects of ethanol production. Furthermore, with decades of experience in handling various types of oils, we have a deep understanding of grains and protein byproducts as commodities, which allows us to effectively navigate the complexities of this market. This expertise is the reason we have decided to enter the grain-based ethanol sector, positioning ourselves to leverage our knowledge and drive sustainable growth in this emerging industry. We have established a 100% wholly owned subsidiary, Modi Biotech, and have strategically entered Raipur in Chhattisgarh. This state, along with Odisha just 100 kilometers away, is rich in grains and produces up to 3 crops per year. This location gives us a significant advantage in easily procuring raw materials. Additionally, our plants are strategically located near all major oil manufacturing companies' depots, which helps us reduce logistic costs and strengthen our relationships with them. We began establishing our plant in April 22 and commenced commercial production in November 23. Currently, our manufacturing facility is set up for 130 KLPD, for which we have incurred a capital expenditure of approximately 150 crore. Furthermore, we are working toward expanding our capacity with an additional 180 KLPD ethanol distillery, which will bring our total capacity to 310 KLPD. We estimate a capital expenditure of approximately 100 crore for this additional capacity, and we have recently completed the engineering work. Construction is set to begin in Q3 of this financial year. We are excited to announce that we have recently secured an order worth 300 crore for our upcoming ethanol year, which spans from November 2024 to October 2025. This achievement is a testament to the hard work and dedication of our team and showcases our commitment to excellence and innovation in the ethanol sector. Receiving this order not only reinforces our reputation as a reliable supplier, but also inspires us to push beyond our limits in pursuit of sustainable growth. We look forward to the opportunities this order presents and are dedicated to delivering high-quality products that meet the evolving needs of our customers. As we expand our operations, we are confident that we will reach new heights and make a significant impact in the industry. Now, coming to our consolidated financial performance, please note that last year, in the same period, the ethanol division was not there. Hence, it is not a like comparable. Q2 FY'25 performance highlights. Revenue from operations is up by 59.5% to rupees 146.6 crore. EBITDA for the quarter grew by 5.8x year-on-year to rupees 14 crore. EBITDA margin stood at 9.6% and PAT grew by 10x to rupees 7.6 crore. H1 FY'25 performance highlights. Revenue from operations is up by 67.6% to rupees 294.2 crore. EBITDA for the quarter grew by 5.6x year-on-year to rupees 27.88 crore. EBITDA margin stood at 9.4% and PAT grew by 9.7x to rupees 15 crore. Coming to our divisional performance. Consumer division. Revenue for Q2 FY'25 stood at rupees 46.6 crore compared to rupees 47 crore in Q2 FY'24, and H1 FY'25 stood at 86.6 crore compared to rupees 85.8 crore in H1 FY'24. Largely, the revenues for Q2 FY'25 and H1 FY'25 have remained flattish on a year-on-year basis owing to a reduction in oil prices and seasonality factors at play. EBITDA for Q2 FY'25 stood at rupees 4.6 crore as compared to rupees 5.2 crore in Q2 FY'24, and for H1 FY'25 stood at rupees 10.6 crore as compared to rupees 9.5 crore in H1 FY'24. Increased in ad spends in Q2 FY'25 had an impact on EBITDA, and this is in line with our strategy. Further, we are scaling up the pasta portfolio under the Olive Kitchen brand with celebrity endorsement and targeted advertising. Overall demand is improving, driven by expanded distribution, innovation, and new product launches in our food basket. Bulk division. In Q2 FY'25, our revenue stood at rupees 19.6 crore as compared to rupees 44.9 crore in Q2 FY'24. And H1 FY'25 stood at rupees 49.5 crore as compared to rupees 89.7 crore in H1 FY'24. The first half traditionally sees softer performance as fresh crops start entering the market from the second half onwards. EBITDA loss of rupees 30 lakh in Q2 FY'25 as compared to loss of rupees 2.2 crore in Q2 FY'24, and in H1 FY'25 loss stood at rupees 1.5 crore as compared to loss of 2.9 crore in H1 FY'24. Ethanol division. In Q2 FY'25, our revenue stood at rupees 80.4 crore, and for H1 FY'25 stood at rupees 158.2 crore. EBITDA for Q2 FY'25 stood at rupees 9.9 crore, and for H1 FY'25 stood at rupees 19.4 crore. The ethanol distillery has stabilized and is currently operating at its optimum capacity. Engineering work for phase 2 expansion has been completed and construction will begin shortly. Given our place today, we believe our consolidated revenues for FY'25 will increase by 75% to rupees 700 crore from rupees 400 crore. Division-wise split will be as follows. Branded division revenue will contribute rupees 210 crore. Bulk oil division revenue will contribute to rupees 215 crore, and ethanol division revenue will contribute to rupees 275 crore. The revenue growth will be attributed to as follows. Consumer division. We will be launching new products in niche categories. Furthermore, our focus will be on expanding our assortment in quick commerce, modern trade, and general trade. We will be hiring a new brand ambassador and increasing our advertising spend moving forward. Bulk division. With good rains and fresh crop starts entering the market and macroeconomic conditions continue to improve. Ethanol division. We have recently received an order for ethanol of rupees 300 crore from multiple OMCs for 41,600 KL, which is in line with our capacity, for the following ethanol sugar year starting November 2024. Along with the sale of byproducts, this firms up our revenue for the upcoming year. We are in the process of expanding our manufacturing capacity to 310 KLPD, i.e. expansion of an additional 180 KLPD with an estimated capex of rupees 100 crore. We expect EBITDA in FY'25 will be at rupees 50 crore as compared to rupees 9.1 crore in FY'24. Further, PAT is expected to be at rupees 30 crore in FY'25 from a loss of rupees 1.4 crore in FY'24. Margins and profitability. Our focus will be on enhancing profitability as increased cash flows will drive greater investment in our branded consumer business. Furthermore, EBITDA margins will improve, supported by a stronger product mix in the branded segment and robust performance in the ethanol business. With this, now I can open the floor for the questions and answers.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Guneet Singh from Counter Cyclical PMS. Please go ahead.
Hi, sir, you mentioned the guidance of 700 CR in FY'25. So I would like to understand whether this is a conservative guidance or an optimistic guidance, and what the downside risk to this. and what gives us the confidence of achieving this? And secondly, I would like to understand the operating margins that we can expect in FY'25 and the steady state operating margins. Because in FY'23 and before that, we were operating in the range of 1 to 3% operating margins, while in this quarter we are observing about 8 to 9% operating margins. So, I mean, what should be the steady state operating margins going forward and for FY'25?
So as far as revenue guidance is concerned, we are confident of achieving it, and it is in line with what we've already achieved so far in the year. And for margin guidance, we've already given an EBITDA guidance as well as PAT guidance. So I think you can extrapolate from there.
So can you please repeat the EBITDA and PAT guidance? I'm sorry, I might have missed it.
So the consolidated revenue guidance is 700 crore, EBITDA guidance is 50 crore, and the PAT is 30 crore.
All right, so got it. Thank you very much.
Thank you.
Thank you.
Our next question is from the line of Sandeep Dixit from Arjav Partners. Please go ahead.
Hi, can you hear me clearly?
Yes, go ahead.
Please go ahead.
Okay. So I just wanted to understand the correlation between EBITDA margin across branded and bulk. There doesn't seem to be any correlation, inverse or either way. Because if, I mean, how does it work? Your EBITDA margin on bulk, for example, has been all over the place. It's gone from minus, let's say, minus 4.81 last year, September quarter, to minus 1.3. Whereas your branded has gone from 11 to 9.92. What exactly, I mean, is there any correlation between the way the branded business works and the bulk business works?
There is no correlation between the two. The two operate entirely independently. The bulk business has two margins at play. One is a processing margin and the other is a trading margin, as it's a low margin business. And as I mentioned earlier on the call, over the last 2 years, we faced some headwinds in the bulk oil business as the government had imposed some price restrictions as well as reduced import duties. So there was a drastic inventory loss over a few quarters. But that has bottomed out, and the bulk division performance will improve going forward. Whereas the consumer division operates on a relatively straightforward margins. There's not that much volatility, more stable margins. And in Q2 particularly, we have mentioned that we've increased our ad spends in order to pursue faster growth.
Yes.
So that's why Q2 margin is a little lower than Q1 margin. Does that answer your question?
Yes, it does. But okay, let's just to follow up on that. What would be a sort of a steady state margin that we can expect in the bulk business? Because last 6 quarters you have made negative margins on this. So does it make sense to carry on that business?
Yeah, I mean, like I said, that's a one-time thing. We have probably never witnessed this in our lifetimes. So that has stabilized. And moving forward, it should be able to contribute. We haven't given that number yet, but anywhere between 5 to 6 EBITDA margin.
Thank you. Thank you very much.
Thank you. Our next question is from the line of Amit Agija from HG Hawa & Company. Please go ahead.
Good afternoon. Am I audible?
Yes, Amit, please go ahead.
Yeah, thank you for the opportunity and congratulations, Mr. Modi. It was an excellent presentation. It doesn't look like your first con call. Extremely fantastic presentation, and most of the things have been cleared. The question was with respect to the FMCG competition. Like, given the expansion of the new product launches, like the initial response, how was the initial response on grain pasta, multigrain pasta, olive peanut butter, ready to mix beverage that's named by Jinx? Are there any other plans for additional products in the coming quarters?
Thank you very much. Much appreciated for your comments. As far as the new product launches are concerned, in multigrain pasta, we have had a very favorable response. And as I mentioned, we are in the middle of scaling up that portfolio pan-India, including targeted advertising. And for the other two as well, as far as the peanut butter is concerned, yes, that's a very crowded market, but we have some product differentiation there. And we aim to carve out a niche for ourselves within that. And Jinx is fairly new. We piloted this in the summer as it's a seasonal product. And we've got a very good response, and we'll be scaling it up in the upcoming season.
Okay. And the last question was connected to the ethanol division. Can you elaborate the timeline and expected final impact on the phase two ethanol plant expansion? And will there be any specific challenges in scaling from 130 KLPD to 300 KLPD?
So, with the experience of the first plant now, we are able to execute faster. The 180 KLPD engineering work is already completed, as I mentioned, and we'll be starting construction as early as maybe 2 weeks from now. And we hope to complete it by the second half of next financial year.
Any specific challenges?
Not at present. I don't see many challenges.
Thank you. It was very helpful. Thank you, and all the best for your future, and happy Diwali to the whole team.
Thanks, same to you.
Thank you. Our next question is from the line of Rohit from Marshmallow Capital. Please go ahead.
Thank you for the opportunity, and I would like to echo the comments of the previous participant. It was excellent opening remark statement. It was quite comprehensive and helped us get a context for the company. So my questions are, the first one on the olive business, the consumer business. So while the year-on-year business revenue is stagnant, even if I see on a yearly basis, last 3 years has been roughly around 150 to 180 crores. So I understand there is a fluctuation, might be a fluctuation because of the edible oil price change, but could you give us a sense of how the volumes have moved over the last 3 years in this business?
So we have not shared volume data yet, but commenting on the revenue, yes, last 2 years, oil prices were down consecutively and down to the extent of almost 40 to 50%. So despite that, we have had stable revenue. And the other reason was also that while we were investing in our ethanol division, we had reduced our ad spends over the last year or so significantly. But now, since all the divisions are performing well, we've increased our ad spends to target a faster growth rate.
Okay, fair enough. But so am I right in thinking that in the oil part of our consumer business, we follow the MRP route, and hence the reduction in oil prices doesn't impact us so much, or beyond a certain level, we do pass on the price benefit? Is that how it goes?
That's similar to most FMCG. So with a little bit of price movement, we manage that with consumer offers, and beyond a point, then we have to take price reductions.
Got it. So is it fair to assume that you have taken considerable price reductions over the last 2 years, and hence the volumes have improved? So in some sense, I want to understand that the market share in the country has improved, because revenue doesn't seem to indicate that.
Yes, I wouldn't be able to comment on the volumes, as I said, but as far as revenue is concerned, you are absolutely right.
Yeah, so I don't want the exact number. Volumes qualitatively, it has improved over the last 2-3 years.
Yes, of course. Otherwise, we won't be able to maintain revenue when oil prices have fallen by 40%.
Okay, thank you so much. And similarly on this, it would be great to hear your thoughts on the consumer strategy in general, because over the last 2-3 years, my assumption was that we would be focusing on becoming a health-focused FMCG brand, extending olive to pasta, peanut butter, etc. So, how does Zinc and People fall in? How does it all dovetail into a coherent strategy? Is something that will be great to hear from you.
Sure. When we look at new product launches, we work on 3 vectors. One is consumer and brand salience. The other is distribution sales. And the third is competition and margin in the category. So we believe that ready-to-cook snack products like popcorn, for instance, the distribution and consumer is the same. The only different thing is the brand there. And same for ready-to-mix drinks. So, for example, in Jinx, we have not launched a ready-to-drink beverage. We have launched a ready-to-mix beverage brand, which also goes through the same channel, which is premium grocery outlets.
Understood. In your comments, you also mentioned that we are the third largest premium oil brand in the country. Would it be possible to share who you see as the top 2 brands, and what is the difference between us as a second as of today?
The top 2 will be, I think, Marico's, Saffola, and Agrotech Sunrock. And I think we're inching very close to the second spot.
So Sunrock, I would not think it is a premium brand, is it? It's a mass brand is what I assume. Am I mistaken?
Within edible oils price ladder, it is a premium brand.
Okay, thank you. And my last question on ethanol, you expect to commission this plant by the second half of FY'26, is that right?
That's correct.
And like for the first phase, we would have a contract hopefully ready with the second phase as well as we launch it.
The contracts are normally, they come out every quarter. So once we're ready with the plant, we'll be bidding for that quantity.
What is the distance between the plants that we have in ethanol and the potential customer? So what is the radius? Just to understand the logistics.
The nearest OMC depots are about 9 kilometers from us.
And that can take the entire expanded capacity as well?
Yes and no. I mean, not necessarily, because there are other plants from other states as well. I mean, OMCs have their own sort of algorithm to allocate depots. For example, in the upcoming year, we've got Jharsuguda in Odisha, etc. So they have their own way of allocating quantities, but they compensate on freight based on what you get.
Okay. Thank you so much. This is very helpful. I'll get back in the queue.
Thanks.
Thank you. Our next question is from line of Tushar Vasuja from Yoga Capital. Please go ahead.
Hello, am I audible?
Yes, Tushar, please go ahead.
Thank you for the opportunity, sir. I have a couple of questions. First one is that you received a 41,600 kiloliter order. So is it a fixed confirm order or is it just an allocation?
It's a confirmed order. The allocation comes as a confirmed order. And for the first quarter, they give you POs, etc. And then they release purchase orders quarterly. But yes, it's a confirmed allocation.
So there's no expectations of any shortfall from the amount that you allocated?
No, it can only be based on our own operational inefficiencies.
Okay, sir. And so it also mentions that the entire order is worth around 300 crores. That comes around to around 72 rupees per liter. So are the prices for 24-25 season out, or is it a rough estimation based on your part?
This is based on the current prices in the tender.
So these prices will be followed for the next year also?
See, the current tender gives these prices, but if there's any price changes, then they communicate that separately through a corrigendum, and that hasn't come yet.
Okay, so there is a chance of the order size being changed later on?
Yes, that's correct. Hopefully only upward.
Yes, sir. And sir, what was the A&P spend as a percentage of revenue for this quarter, and how will it shape up going forward?
So we'll get back to you with that data, please.
Okay, sir. And sir, last time we talked, you mentioned that you are thinking of, you have thoughts of winding up or spinning off the bulk oil division. So any update on that?
No, it's too soon. Like I said, we will take that decision as and when.
Okay. And sir, just last one question. Is the Concall going to be a regular quarterly thing from now on, or no?
Yes, that is our thought process. Yes.
Okay, sir. Okay, sir. Thank you.
Thank you. Before we take our next question, we would like to remind participants that you may press star and 1 to ask a question. Next is a follow-up question from the line of Rohit from Marshmallow Capital. Please go ahead.
Yeah, so I just wanted to confirm the EBITDA margin possibility for... So is this the standard, the normalized EBITDA margin that we can generate around 12.5 that we see this quarter?
For which division?
Ethanol division, sorry.
Yeah, ethanol division, as I said, I think given where we are and how we're operating our plants and the value addition we're doing on our byproducts, I think 10 to 12% margin is achievable, maintainable in the near to medium term.
But this would, the band would expand once we come into the new capacity, is that right?
I think it's kind of modular, right? So only some amount of operational leverage is there in terms of manpower costs, etc., but the product cost remains the same.
Sure, understood. And so what is the working capital? I mean, let's say the working capital investment as a percentage of sales for the ethanol business on an annual basis?
On an annual basis, I'll have to check that number. We'll get back to you on that.
Yeah. So effectively, what is, the payback period or the return on capital on an annual basis we can get from ethanol is what I'm trying to understand. That's it.
Yeah, I mean, my team informs me that for FY'25 ethanol division, we're looking at ROCE of approximately 18.5%.
Okay, that's helpful. Thank you. That's it from me. Thank you so much.
Thank you. A reminder to the participants that you may press star and one to ask a question. Our next question is from the line of Akshay Jain from Jain Capital. Please go ahead. Akshay sir, your line is unmuted. Please go ahead with your question.
Hello? Hello?
Yes, please go ahead with your question.
So a couple of questions from my side. So, firstly, sir, can you help us better understand the bulk oil business? So what are the key drivers in the business? How are the pricing contracts decided in that segment? And how should we look at going forward? And is there any entry barriers for other players to enter in this particular vertical?
The bulk oil business is an oil processing business, and it's a legacy business. We've had it for the last 40 years, and these plants are very efficient. They've been around for a long time, and since it's in our geography, we are based on a local raw material base, so it's basically primarily dependent on a processing margin. And in terms of barriers to entry, it's kind of limited by the local raw material availability. So I think the capacities in our region are kind of optimized, and there's very little room for any more plants to come up.
Understood. And so the pricing contracts?
No, it's commodity pricing. It's fluctuating on a daily basis.
Okay, understood. Sure. I think that's all from my side. Thank you.
So I'll just go back to the previous question. I think there was a mistake. The 18.5% ROC number is on a consolidated basis, not just ethanol. That number would be higher. We'll get back to you with that.
Thank you. Our next question is from the line of Ankit Minocha from Adezi Ventures Family Office. Please go ahead.
Yeah. Hi, good afternoon, Akshay. And apologies, I've joined the call a little late, so if this is slightly repetitive. I firstly wanted to understand with regard to the bulk business. I mean, with the rice prices expected to be relatively docile moving ahead, what is the kind of margin profile that you would probably be looking at for the bulk business, say for H2 of this year?
So the bulk oil business, we process rice bran, not rice particularly. So rice prices don't have any bearing on this. So as far as margins are concerned, as I mentioned, typical, steady state margins are about 5% EBITDA margin. Since the first 2 quarters have been a little muted, we hope that in the second half of the year, once the new season comes in, we'll be able to cover up.
Understood. Thanks for that clarity. And secondly, the growth trajectory given in the guidance is also as per the results, which were excellent. That looks clear. In terms till Q4 say of this year. Just wanted to understand beyond that, say for the year after that, what is the thoughts to kind of maintain the strong growth that we're kind of going to be seeing from ethanol this time? Are there plans for capacity expansion or anything else that you have in mind?
Yes, as I mentioned in my opening remarks, we have growth plans for the consumer division as well as the ethanol division. And the ethanol division, we're expanding our capacity from 130 KLPD to 310 KLPD, adding 180 KL. So that new plant should come online by second half of FY'26. And given the cash flows that we're generating now in the company, we aim to increase our ad spends and investment in the consumer division and grow that faster as well.
Understood. So when we say H2 of 2026, so that means, same time probably next year, right?
Yes.
Yeah. Thanks a lot. Thank you.
Thank you. The next is a follow-up question from the line of Sandeep Dixit from Arja Partners. Please go ahead.
Thank you. Just a bookkeeping question. The difference between the standalone and the Concall numbers, I presume, is the ethanol business. Am I right?
That's correct.
Okay. Is that a wholly owned subsidiary? I'm sorry for asking this question.
Yes, it's a wholly owned subsidiary.
Thank you.
Thank you. Our next question is from the line of Faisal Hawa from Hawa Capitals. Please go ahead.
Sir, the EBITDA margins in the ethanol divisions are rather low than projected before. So is it because the rice procurement prices have been little higher this year?
Are you talking about Q1 and Q2, the 12% EBITDA?
Yes. And plus, we are projecting also going forward 10 to 12% only.
Yeah, I mean, 12% is a number that I've talked about for a long time. Obviously, in the first 2 quarters, the crop is not there. So now in Q3, Q4, the crop comes in. So the margins on an average basis could be a little higher for the year.
So fair to assume that on a steady state basis, it will be 12%?
Yes, in the region, yes.
And second is that what is our strategy with regarding so many brands? So are we trying various things and then maybe 1 or 2 brands will emerge as blockbusters? And how are we doing with respect to quick commerce and modern trade? How much is our sales to both of these channels? And which channels do we propose to now increase? And what do we want to do with our legacy oil business? Because that business is always a drag on our margins and overall workings also.
Sorry, that was multiple questions, so I'll try and answer them one by one. As far as the number of brands is concerned, I mentioned earlier that we identify white spaces within our distribution and brand salience, and we launch products. Of course, some of them will be able to, be blockbusters, and some will sort of get us a decent enough market share with a profitable growth. So that is our objective. And we aim to leverage all the channels, all distribution channels that we have. And we're present across the spectrum from Q-commerce to e-commerce, modern retail, general trade, as well as the CSD army canteens. And the channel mix will change as the channels evolve. It's not like we are paying special attention to just one and not the other. But yes, like you said, I mean, quick commerce is growing much faster. I think they're contributing to almost 15% of our top line now, and the number is growing very fast. So let's see how it plays out. And I think the last question was?
About the legacy oil business, which is...
Yeah, so that the management will take a call as and when. It's probably still a bit early. We hope to scale up the other 2 divisions in the near term and then take a decision on that.
And when will we take a call to actually manufacture our own products like noodles, etc., pasta, and not contract manufacture them? At what point, or do you have a value in your mind where you will actually then do the manufacturing ourselves? And how many percentage points will it add to our EBITDA?
So right now we're operating on an asset-light model, and once specific products like pasta you mentioned are scaled up enough where it warrants backward integration, we'll do it if we see there are margins in it. So right now it's too early to say.
And what will be our branding strategy and advertising? Will it be like different brand ambassadors for each of for pasta and noodles and for again oil, or will we kind of go in for more of a social media branding strategy where we have a very targeted approach to our audience?
See, social media is one of the media vehicles that we use, but it's part of a larger digital marketing strategy. And these days, even television, which is, for example, CTV, connected television, forms part of digital itself, but it's actually television. So we use all the different media vehicles. And as far as brand ambassador is concerned, we could sort of make a deal for oil as well as pasta, which we will be announcing shortly.
And are we particularly weak in South India, or is it not a right statement to make?
South India is also quite vast. So, for example, in Andhra, Telangana and Karnataka, we have decent volumes and market shares. Maybe Tamil Nadu and Kerala, we are relatively weaker as we entered those markets much later, and we hope to catch up.
Okay. And beyond this 310,000 ethanol capacity, it's difficult to expand at current location?
We have not thought beyond that at the moment.
Okay. Thanks a lot. I appreciate you answering my questions.
Thank you.
Thank you. Our next question is from line of Rohit Khakar from 4P Capital Partners. Please go ahead.
Hi, thanks for taking our question, and thank you so much for this fantastic presentation, Mr. Modi. Just a couple of questions that we had from from our perspective. One is, could you help me understand what is your utilization level at the ethanol plant for the last quarter?
So in Q2, it's fairly optimum. I think we are almost at about, let's say, 90 to 95%, and it will only increase going forward.
Got it. Okay. In terms of your consumer business, what's the split in revenue from your edible oil versus non-edible oil business?
What is the revenue split?
Yes.
Yeah, the segmental revenue is in Q2, we've done 46.6 crore from consumer division and 19.6 crore from the bulk division.
No. So my question was, within the consumer division, what is the split between edible oil and non-edible oil?
So we don't give that split.
Okay.
But you can say foods would be about, non-oil sales would be about 15%.
Understand. Okay. And for your capacity expansion on ethanol, how do you intend to fund that? That itself will require about 100 crores. So is it internal accruals plus borrowings, or are you looking to do capital raise?
So about out of 100 crores, the plant will also take about a year to establish, and the fund flow will be such that I think we'll have about 50 crores through internal accruals, and the rest through either debt or equity, and the management is yet to take a decision on that.
Okay. But 50 crores could be done through internal accruals, and that's what the expectation from.
Yes, that's correct. Yeah. So there's not a major gap between what we need and what we have.
Sure. Yeah. Okay. Thank you.
Thank you. Our next question is from line of Shaurya Punyani from Arjav Partners. Please go ahead.
Hi, am I audible?
Yes, Shaurya. You're audible, yeah.
So I have two quick questions. So we have guided for a big 75% growth in FY'25. So what is the growth momentum we are seeing subsequent, like FY'26, 27?
So we haven't given a number for that yet, but like I said, we expect high growth from two divisions, which is the ethanol division and the consumer division. In the ethanol division, we will be increasing our capacity from 130 KL to 310 KL, and that expanded capacity should come online by second half of FY'26. So that gives you growth for FY'26 as well as FY'27 when we get the full year for that plant as well. And consumer division will continue to grow.
Okay. And what is the current ad spend to sales ratio? And
So we'll get back to you on that number, please.
Okay, sure. Thank you.
Thank you. Next is a follow-up question from line of Ankit Minocha from Adezi Ventures Family Office. Please go ahead.
Yeah, I just wanted to also understand that the recent import duty on oils, how does that affect us, whether it's positive or negative, and would that also mean price increases due to some compulsion or due to strength?
So your first question is about the import duty. So let me answer that first. As far as the consumer business is concerned, we've taken price increases, so it's a positive impact on revenue side, whereas margins should remain stable. On the bulk business side, it's a very positive impact because as prices increase, trading margins will reverse from negative and come back into positive. And at higher price points of oils, we feel that more raw material comes into processing for oil rather than going for other uses. So it's a positive impact for our bulk business as well. What was your second question, please?
I think you've already answered that in terms of the price increase. So any price increases planned in the consumer business as well?
Yes, so that's already happened.
Yeah. So what is the import regulation? How does it affect you in terms of the olive oil, the change in import regulation in terms of raw materials?
I didn't understand your question, sorry.
Just the regulation, the new import regulation, does that mean that the raw materials also become...
You mean the import duty?
Yeah, the import duty.
The import duty has gone up on other soft oils, not on olive oil. The olive oil import duties are already at the peak.
Right. So could there be also a play coming from substitution into olive oil?
So our product portfolio is very diversified and strategically, positioned to take care of this. So we have pure olive oils, and then we have multi-source edible oils, which are blend of olive oil with other oils, and that helps us maintain, price points and margins.
And in the blend, does this import duty impact you?
It impacts us on other soft oils. So for example, if import duty goes up on palm oil, soybean oil, and sunflower oil, it affects the entire basket at the bottom end, so even rice bran oil prices go up. So it affects us to that extent. And we've taken price increases for the multi-source oil, and so has the rest of the industry.
Understood. So thanks for the color there. Secondly, this might be slightly hypothetical, but is there any link to Godfrey Phillips as a business?
Any link to?
Any link to Godfrey Phillips at all as a business for you guys? I believe your office is close by, but...
No, they are two different entities.
They're completely different, is it?
Yes.
So no synergies of distribution or anything?
No.
Okay. And any chance you guys are looking for a preferential or an equity fundraise anytime soon?
So I answered this question on the previous one as well. Maybe in future we could look at something. We haven't taken a decision on how to fund our expansion of ethanol through debt or equity. But in the future, that is a possibility, but I wouldn't be able to comment on that right now.
Right. Thank you so much. Thanks.
Thank you.
Thank you. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Mr. Akshay Modi for closing comments.
Thank you, everyone. I hope we have been able to answer all your questions satisfactorily. However, if you need any further clarifications or want to know more about the company, please contact SGA or our investor relations advisors. Wish you all a very happy Diwali and a prosperous year ahead. And thank you once again for taking the time to join us during this call today.
On behalf of Modi Naturals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.